This is the L2 Capital Podcast with hedge fund manager Marcelo López. The L2 Capital Podcast focuses on potential opportunities in the market and brings to your industry leaders and an intelligent conversation about their respective areas of expertise. And now, here's your host, Marcelo López.
Hello everyone and welcome to the L2 Capital Podcast. I have the pleasure to talk today to another hedge fund manager, famous for his out-of-the-box ideas, Harris Kupperman, also known as Kuppy. Kuppy is the founder of Uranium Capital, and like me, he's always on the lookout for great asymmetric investment opportunities. So Kuppy, welcome to this program. It's a pleasure to have you here.
Hey, thanks for inviting me. I really appreciate it.
My pleasure. So could you please tell us a little bit about yourself and Uranium Capital?
Oh, wow. Where should I start? I'm an investor who looks for asymmetric opportunities. I feel like most of the equity markets roughly fairly priced or slightly overpriced. And the opportunities are in the weird, esoteric, funny sectors of the world that no one's following, or they have this yuck factor to them that forces people not to want to look at them. And I feel like a lot of these potentially have big upside. I'm not the type of guy who says, I'll buy this stock at 10 because I think it's going to 12. I'm the type of guy who says, let's buy this stock at 10 or whatever, because we think it's going to 100. And sometimes it works, sometimes it doesn't. But if you protect your downside, you get enough of those that go up. And I write a blog, Adventures in Capitalism, where I talk about what I'm buying and what I'm investing in and what I'm thinking about. And we've had some pretty big winners there over the last few years, lots of doubles and triples. So that to me, I also run a hedge fund. It's an old school hedge fund, 6 to 12 names, concentrated, all asymmetric trades, hopefully uncorrelated. And we're really looking to put up good numbers over any rolling 3-year period, month to month, quarter to quarter volatility just doesn't matter to me. If you want to learn more about my hedge fund, go to praycap.com. But I'm not going to talk about it here just because you have those marketing rules.
Got it. Thanks for that. So how are you seeing the markets today? Because everyone says it's a bubble and it's about to burst, but it only gets bigger. Do you see a crash, or will central banks try to avert this and print even more money? What are your thoughts on the markets today?
So I really thought we were going to crash this summer, fall. I mean, I think the market thought we were going to crash, and we didn't crash. And why did we not crash? It's because they did not QE 3, 4, whatever. I lost track which number it is. But that when you print money, you can prop up the markets. I do think we're still going to crash. I think there's two factors driving that. On one side, I think the Ponzi sector is bigger than people think it is. And the Ponzi sector is kind of freezing up, where if you're an owner of Ponzi stocks in the private world, you only put money in because you think there's some sucker who's going to buy it from you in an IPO or, in a secondary offering in the public markets. But what we've learned is that these things are worth a lot less than anyone thought. So to put money in, you have to put it in at a discount to where you think it's going to price, which means that guys who already own the shares are going to take write-downs. And with debt in the system, no one wants to write down. So you have this situation where no one wants to put new money in, and the existing investors don't really want to put more money in because you got to put billions of dollars a year into these things just to keep them going. And keeping them going just kind of means that they lose more money. So you have to put more money in. It's this good after bad. So I really do think that it might not be today or tomorrow, but the whole system is freezing up, and I think you're going to see a lot of capital. And coincidentally, I think you'll see that a lot of the jobs created, a lot of the house price, just a lot of the economy is tied to fake stock options and fake valuations in these things. And when people see the write-offs and, you get a stock wrong, maybe it drops 20 or 30%. When you have a business that's structurally unprofitable, it's going to drop 100%. And dropping 100% from a multi-billion valuation is a lot of money times hundreds of these things. But the other thing I think is going to happen is you're going to see an uptick in inflation. And as inflation starts ticking up, and it already is ticking up, I really do think you'll see the central banks finally lose control of the process, where they won't be able to keep stimulating. And it's not just stimulus, it's incremental stimulus to keep the thing going. And if they can't keep stimulating and they slow down the stimulus or maybe even go in reverse again to stop the inflation, I think you're going to have a world of pain. I think the two things are going to kind of collide. It wasn't a 2019. I've stopped out of my shorts and lost a couple hundred bips. No big deal. But I'll take another shot at it at some point. And I think we'll know pretty clearly when it's going to blow again, or almost blow.
Yeah, I had that impression late last year. But anyway, you mentioned something interesting. And one of the things I always thought of is that private markets are way more efficient than public ones, simply because you have two sides who are really well advised by professionals. But this seems not to be the case anymore. Today, the private markets are valuing companies at much higher price than the public markets, maybe with the exception of Tesla. But anyway, this week we were surprised with the offer from KKR to buy Walgreens at a price probably higher than $60 billion, making it the most expensive buyout ever. And there's the likes of SoftBank, which is buying anything at whatever price. So to be more specific, what do you think will come out of this private equity mania?
I think you have to look at why there's a premium to private versus public. And I really do think it comes down to mark-to-market risk. You have pension funds and other allocators, and for a very long time, they've just bought an index fund or they've bought individual equities, but there's volatility to that. And increasingly, I think people don't want to show volatility of any type. The world has just, for whatever reason, decided that they're anti-volatility, and especially that institutional world. So rather than owning Walgreens on the stock market, where you're going to buy it at a cheap valuation, in theory, to what KKR is paying, people would rather buy it with a few turns more debt in a private market at a higher price. Why? Because it's now just going to be marked to a model, and the model is going to slowly increase every year. And so what you've done is you've eliminated the volatility of owning the stock. Oddly, you're actually paying more for it. Plus, you're increasing the risk because you're putting debt on it. But assuming Walgreens continues to grow or produce cash flow and amortize that debt, I mean, the IRR will be reasonably okay, I guess, but it still doesn't make any sense why no one wanted it last week at a cheaper price. Then the smart guys are willing to pay at a higher price. And it's all because of this issue of a pension fund can't showing that volatility to their people who monitor the process, their stakeholders, whoever they may be.
Got it. Okay. And the likes of WeWork, do you have something to say?
I think SoftBank will probably have to do another down round at some point in the future.
Oh, for sure. For sure. I was laughing here because I saw the slides that Masayoshi-san put on the screen with the EBITDA going down and then suddenly going up without any numbers. I say, oh yeah, that summarizes the markets today.
Yeah, that summarizes them. It looks like a first-year B-school presentation. They are selling the wave pool company, though.
So, Kapi, I have heard you say something really interesting, the long shorts. Can you tell us what those are and why they can be multi-baggers?
Yeah, sure. So, I think we're having an economic crisis of some type. I think you're going to see increasing inflation, like I said, and an economic crisis that will be hard for the central banks to fight, even though they'll probably try. And I want to be taking advantage of that. The problem with being short is if you print money, you might crash upwards. If you think of Venezuela or Zimbabwe or Weimar Germany, those stock markets actually went up thousands of %. And that's because they just printed money to try to sweep the crisis underneath. And that's the risk with being short. And we just saw that in Q3 where they started printing money and all the stocks went up again. It's just a hard way to bet on an economic crisis. You have your traditional methods like owning gold, but I think there's more than just gold. And I think some of these long shorts are the way to do it because you might have multi-bagger upside potential where if they don't print and the market crashes, these should still do very well because their businesses will do very well. If they do print and the market crashes higher, I think these do well anyway and potentially even better. I just think this is the way you play the economic crisis that is coming.
Got it. Can you give us an example?
So let me tell you, it's my favorite one. It's a stock named Altisource. It's my second largest position. It's a default mortgage servicer. And most people don't know what that means. But that means if I don't pay my mortgage, starting when I'm 15 days late, they call me up. Cuppy, you haven't paid the mortgage. And then 30 days, they call me again. And then I get a letter in the mail. Then I get an angry letter in the mail. Then eventually they start court proceedings. They try to evict me. They try to foreclose my property. Once they've gotten me out of there, they have to maintain my property, make sure I'm paying my insurance and my homeowner's condo fees and make sure that I'm paying my property taxes. And it's this bureaucratic, messed up process. And because every state and every county has its own funny patchwork of laws, it's the sort of thing that banks don't really want to get involved in. Plus, it's a bad look for a bank to be kicking out a single mother. So this sort of thing gets outsourced to default mortgage servicers. And because of a lot of consolidation over the last few years, and remember, the number of defaults has declined every year for almost a decade now. It's been a horrible bear market. You've seen a lot of consolidation. You've seen a lot of guys leave the industry. You've seen a lot of banks get rid of their own internal default mortgage servicing operations. So you have this really consolidated industry that's genuinely a very good business. When you think of a good business, it's an asset-light business, something of an oligopoly amongst a few players. You have some pricing power. Returns on capital are amazing. It's just a really cash generative, lucrative business. And yes, for 10 years in a row, this industry has earned less money each year because the number of defaults keeps dropping. But an interesting thing happened in Q2 this year. You had the first year-over-year increase in defaults in 10 years. And that's with interest rates at lows. That's with, unemployment low. In the end, if property prices don't go up and people can't cash out refi, they start going down because there's always people who are stretched buyers that need cash out refi to keep the machine going. It's like a shark, it swims forward or it dies. And what we see in house prices is that it swims forward or it dies. So if you start seeing property prices stagnate, you see an increase in defaults. If you see property prices decline, you see a bigger increase in defaults. If you see something bad happening in the economy, you see a bigger increase in defaults. And Q3 interest rates dropped quite a lot. There was some more cash out refi. The number of defaults declined again, but interest rates backed off again in the last couple of weeks. I think we're going to bounce along the bottom here until the crisis starts. But, anytime you could buy a company at 10 years cyclical lows of earnings, and I think Altasaurus, which right now, what's the market cap? It's a 280 million market cap. I think they earn in cash flow around 100 million next year. So you're paying 2.8 times cash flow for a business that has been shrinking for a while. I think it's probably going to be growing next year. At worst case, it shrinks a little, depending on what Ocwen is going to do. Ocwen is their biggest customer. But you're paying 2.8 times for a very high return on capital business. What we've seen in the rest of the market is that asset-light service providers, 15 to 25 times. I mean, this could be easily a 10-bagger just if it could prove that the cash flow number kind of stabilizes. But what if the default start upticking? I mean, why can't Altasaurus have 200 million of cash flow? I mean, why can't you put a 20 multiple on that and it's a $4 billion company from 280 today? I'm not saying that's my model or that's what I think happens, but
sure.
I mean, why can't it? They did 400 million a year for multiple years during the last cycle. And I don't think it gets as bad as last cycle, but they've also taken a lot of costs out of the system. They've diversified the business.
Think that the next crisis will be similar to the previous one?
No two crises are exactly the same. What I will say, though, when you look at homeowner defaults or you look at just home ownership, last cycle, what they did to solve the problem, quote unquote, solve the problem, was just took rates down. So everyone was able to cash out refinance. Everyone was able to lower their financial carrying cost. So your financial carrying cost is your interest payment and your mortgage debt amortization. So they've taken that cost down by lowering interest rates. But what you've seen happen is that the total ownership price of a home includes other things: property tax, insurance, maintenance, you have condo fees and utilities and all this other stuff. So the percentage of the total ownership price that is your financial side, your mortgage, has actually declined versus the cost of the other stuff. And the other stuff is actually increasing quite rapidly as inflation goes up. So you're kind of having this situation where they can't take rates that much lower. And even if they do, you still have this amortization process. Meanwhile, on the rest of that pie of the cost of owning a home, it keeps going up. Plus you have home ownership in terms of multiples of income at one of the most stressed it's ever been in the history of humanity. Depending on which market you're in, it's actually worse than it was in 2008 or 7 at the peak of the last cycle. So, if you see things roll over, you see, inflation pick up a little. I don't think the Fed has as many tools this time to keep people in their homes. And it's very political. They'll try everything they can, but, it can be reasonably bad. I mean, the thing about last cycle is that a lot of defaults cured themselves because rates went down. It's harder to have cures this time. I just don't know what it looks like, but I just know that we're way below trend line in terms of default rates right now, looking at this from a 25 or 50 year historical numbers. So if we just move back to trend line, I think Altasaurus is a couple $100 stock. And I like these sort of situations where you can look at an industry that, it's had a bad run for 10 years because defaults are down, but you can look at it and see that it's cheap, but you could also construct a macro view that says that, there's a tailwind because stocks stay cheap forever. That's just been what I've learned. You need a tailwind that unlocks it, or you need some sort of catalyst event like a buyout or something like that. But when you have a macro tailwind, you can get huge, couple 100%, maybe 1,000% returns. And especially when you're in asset-light business like default mortgage servicing. So always look for what your tailwind is. You can't just have cheap.
Got it. So is there a place in the world that you're looking into at the moment for value? Like Greece, maybe Chile or Argentina or something like that?
No, everything's overvalued. I mean, I'm sure there's going to be value in Argentina. I'm sure there's value in Chile. I'm no expert in those markets. I really can't give you enough color. I've really pared back my Greece exposure. I'm up 20% in a few months. And it's one of these things where, I don't know, in the end, the Greek economy really relies strongly on tourism. And when the economy goes bad globally, and every metric I look at, every PMI, everything you can look at possibly is rolling over. Well, what's the first thing you cut when you have no money? Your tourist budget. So if that's such a big piece of the economy, then it's going to get hurt too. And I don't know. I just don't see the opportunity there. If I had to say where I'd go look, I think the best sectors right now are in commodities. Unfortunately, they go down every day. So every time you look at it, it's a little bit cheaper. But I think the best opportunities right now are commodities. There's been a real dearth of new supply in most industries, and commodities is this monolithic thing. So you have industrial commodities, you have energy, so you have to look at them. But looking through the periodic table, there's places where there's real opportunity because there's been underinvestment, there's historic low valuations, and quite honestly, I think you're going to see inflation, and I also think you're going to see world governments try to do some stimulation. And the easiest thing to do for stimulus is bridges to nowhere, and that chooses up a lot of commodities.
Got it. Do you have a preferred one?
Commodity?
Yeah.
Well, I think uranium's going to do great. I think you're going to, I think uranium prices, which are around 24 today, I think at some point in the next few years, you're going to be looking at a double or triple. Commodities are commodities to me. And I know a lot of people love gold right now, and I own some gold, but I don't know if gold's going to double or triple outside of some sort of hard fiscal, monetary, geopolitical crisis. But I think uranium almost has to double or triple because that's the cost of producing this stuff. And when you have a deficit, no one's going to go back to producing unless they can earn some money.
Sure. And you also participated in the last uranium bull market, right?
Oh, yeah, that was great.
Can you tell us what happened at the time and how you played it?
So the last uranium bull market was... So just taking a step back, I follow a lot of commodities. I love these commodities that have very long, drawn-out bear markets where the price of the commodity is below the cost of producing it. Everyone goes bankrupt. People stop producing. You have huge deficits, and no one really cares. And uranium was one of those where you had basically this Russian weapons-grade uranium flooding the market because of a deal the U.S. made with the Russians. And so it effectively bankrupted everyone in the industry, or almost everyone. And so you had supplies get worked down. You had no new supply. You had no new producers. And then the price started going up. And the price started going up for a few reasons. One, utilities started getting concerned that as the weapons program ended, there'd be not enough uranium, so they started increasing their own stockpiles. You had financial buyers show up, and a bunch of hedge funds bought uranium and try to front run the utilities that were also buying uranium. And then finally, you had some real problems at large mines, Cigar Lake, MacArthur River. And what it did was it panicked people that wouldn't be enough uranium. And of course, utilities are kind of slow and dumb, and hedge funds are in this to make money. So they just front ran the utilities. And as the price started going up, utilities started panicking, even though there's plenty of uranium out there when you really think about it. When you just look at the numbers, there's plenty of uranium. But the concern with the utilities is that uranium is such a small piece of operating the nuclear plant, yet, all you have is a paperweight if you don't have uranium. So the utilities panicked and they massively increased their own stockpiles. And as I said, the hedge funds all front ran them the whole way up. So you had this real kind of super cycle in commodity prices during a time when there's kind of plenty of uranium when you really think about it. I owned a bunch of junior producers. Back then, a lot of these junior producers were $5 and $10 million companies. And when the cycle ended, they were a few $1 billion companies. It was quite great. I owned 5 to 10% of most of them. There was 9 uranium stocks when I started this, when I started investing in uranium. And I was just under filing limit on all of them, except Cameco. It was just a great run. I think this cycle is going to be different because this cycle you have true deficits. There's still above ground stocks, but they're getting run down pretty fast. And I think the difference this cycle in terms of how to play it is I think you should stay away from the juniors because a lot of them are quite fairly valued or maybe even overvalued. I mean, it's kind of odd to think that you can have a non-producing junior with a couple $100 million market cap. I don't care how good the grades are.
Another kind of commodity. What are your views on shipping?
I think we're in about the second inning of a super cycle in shipping. Just going back to, what I said about uranium or other commodities, and I really do like cyclical industries, is that you look at these and you need to have a process where everyone goes bankrupt. There's a winnowing of the industry. There's a crisis. A lot of capital gets destroyed. And that's shipping for you. For 10 years, everyone lost money. That's because people ordered too many vessels, 2006 to 13 or so. And just vessels kept hitting the market until about 16, 17. And then no one ordered any more vessels because they had no more money to order vessels with. And what you've had now is a lot of scrapping. You've had increase in demand because shipping transport volume grows every year, and it's kind of caught up with the existing supply. But what's quite unique is you have this gating function called IMO 2020. IMO 2020 says that going forward, you have to burn low sulfur fuel that has 0.5% sulfur, or you can install a scrubber. And there's been a lot of debate as to the effects of IMO 2020 and if scrubbers are the right trade. And I don't want to get too deep into the weeds on that because I honestly don't have that strong of an opinion. What I will say, though, is that it is a gating function. I think you'll see a lot of older vessels that are marginal vessels getting scrapped. I think you'll see vessels that are older do some slow steaming, so they take some supply out of the market. I think you'll see a lot of disruption and chaos. Think of it this way. You take your car and you put diesel in it, and it's not a diesel car. I mean, just think what happens to your car. And I think you're going to see a lot of that as people start using VLSFO blends when, they haven't really thought through the implications. You can see ships stalling out. You can see lots of lack of fuel in ports. I think you're going to see a lot of chaos. And chaos is very good for shipping. The other great thing about shipping is it's a way to play geopolitical volatility. I think we're entering a cycle of increased geopolitical volatility and balkanization. And it's not just Trump kind of tweeting at people. It's every other country having their own little balkanization and, changes in trade routes. And every time you change trade routes, you make things less efficient, which means you need more vessels, which puts upward pressure on charter rates. So we're in a situation, and, a lot of these shipping stocks have now doubled. I've been talking about shipping on my blog since the start of the year. So, if you bought pretty much anything, you doubled your money. But I think we're in the very early stages because while charter rates are up and these guys are now covering their cash costs, they're not really making any money. They're certainly not making enough money to pay down much debt and definitely not enough to start buying new vessels. Don't forget, when you have a vessel, that amortization, the depreciation is real. It's not that something that you can just add back and ignore. In 20 years, your vessel gets scrapped or maybe even less. And so you've had a lot of these vessels that have already used up a lot of their depreciation potential, and people need new vessels at some point, but they're not making enough money to replace the vessels. And so I really do think that you're going to see charter rates go up quite a lot more. I think IMO will be the catalyst that pushes rates up. And if you look at past shipping cycles, these things don't just double. I mean, they don't usually stop at 5 times. They go to 10 or 20 or more. If you look at the last cycle, you had companies like Frontline that were 50 baggers. And I mean, we're talking about 50 baggers on multi-billion-dollar companies. So it's a lot of value created here. And I just think it's the best place to be. My largest position is a company called Scorpio. They're a product tanker company. They're the largest pure play product tanker company in the world. And IMO 2020 will increase the demand for low sulfur fuel. The low sulfur fuel goes on a product tanker. I assume that rates will go up quite dramatically as a result, and I think Scorpio will make a lot of money.
Awesome. The tankers are the preferred way to play this?
Yeah, I mean, look, I think every sector of shipping will do well. Car carriers and dry bulk, it'll all do well because the same factor in IMO 2020 is at play, where older tonnage gets scrapped. But what you're going to see with product tankers is that the need for moving diesel and MGO, and I think you're going to see a large increase in the demand side there, which should dramatically push up charter rates well beyond what you're going to see in, say, dry bulk, where maybe demand actually doesn't grow very fast. Dirty tankers may actually see some demand destruction as less high sulfur product gets moved around and more low sulfur product. I really think you're going to see it there and then in LPG, which has already done quite well as well. But when you think about this, I mean, just to show you the operating leverage on a company like Scorpio, if LR rates are about 50,000 and MR rates are about 30,000 over the course of the year, Scorpio makes $25 a share. That's cash in your pocket. It's a $30 stock today. Will rates get there? It's hard to say, but rates were well past there last month. They've pulled back a little this month. I expect they spike again into winter just because because you have a strong seasonal in the winter.
Sure.
I don't know. Maybe they make $10 this year, so it's 3 times. But you're coming into this company even today at a discount to net asset value. And given the high returns on capital, it really should trade at a premium to net asset value.
Got it. So, Kapi, again, it was a pleasure to talk to you. Thanks for coming to this program.
Yeah, happy to.
And it's good to know that I'm not alone in my views.
Which views? Which views?
Well, all of them. The SoftBank, the private equity mania, the shipping industry, commodities, pretty much all of them.
Well, let's hope we're right.
Yeah, exactly. That's an important thing. Awesome, Kapi. Listen, thank you so much.
Hey, thanks for having me on. Appreciate it.
Talk to you soon.
If you like this podcast, feel free to forward it to your friends and colleagues. We appreciate your time, support, and your feedback. You can follow Marcelo Lopez on Twitter at MALopez1975. The information presented here is not investment advice and should not be taken as such. You should do your own due diligence and consult with your financial advisor before doing anything suggested or mentioned in this podcast. L2 Capital and its partners will not be liable for any losses that occur in doing whatever is discussed in this podcast.